Americans are leaving the country in record numbers, permanently, and they're taking their wealth with them. The State Department is processing more expat filings than at any point in modern history. Wealthy Americans are renouncing citizenship at rates that we've never seen, and the headlines are finally catching up to what we've been watching with our own clients for the last decade. I'm Vincenzo. 15 years ago, I left a Wall Street career to live abroad, and I've been running an international tax firm ever since, working with Americans in over 93 countries. In this video, I'm gonna cover what's actually happening behind the headlines, what the smart movers are doing right, and what most people get wrong when they try to follow the smart movers. Here's what the data shows, separate from the headlines. U.S. citizenship renunciations have hit record highs in recent years. Expat tax filings have been growing steadily, and the type of person doing this has shifted. It used to be the retirees moving to Mexico for cheaper healthcare. Now it's people like me, 30, 40-year-old founders, remote professionals, and high earners with family moving to places like Lisbon, Mexico City, Dubai, Singapore, and a dozen of other cities. The money's moving with them. And not in that dramatic, suitcase full of cash kind of way that the internet likes to talk about, but in the boring, legal, properly reporting way. Foreign bank accounts, foreign real estate, properly structured residency in countries that tax favorably, income protected by the Foreign Earned Income Exclusion. This is happening quietly, but it's accelerating. The reason the financial press is finally writing about this is because the people doing it are no longer fringe. They're successful, financially literate, and making a calculated decision. So let's talk about what that calculation actually looks like when it's done right. 3 moves in this order, and the order matters. Move 1, they figure out the tax piece before the move. Most people get this backwards. They book the flight, they sign the lease in Lisbon, then they start researching how taxes work. But by then, it's too late to capture some of the biggest benefits. The Foreign Earned Income Exclusion lets qualifying Americans exclude roughly $130,000 of earned income from U.S. tax every year. And for a married couple, that doubles to $260,000. To qualify, you generally need to be physically outside the United States for at least 330 days in a 12-month period, or genuinely set up as a resident of another country. But if you don't plan the time of your move, you could disqualify yourself for a full year of FEIE without even realizing it. The smart movers map this out before they go. But protecting the income side is only half the math. The second move is about everything that's already been built up. Move 2, they diversify where their assets actually sit. This is the move that the nomad capitalist crowd talks about constantly. And they're not wrong about this principle. The mistake most people make is jumping to I need an offshore bank account. But that's before they actually understand why. The principle is simpler than the marketing makes it sound. If 100% of your wealth, your bank accounts, your real estate, your business, your retirement is in one country, that's called concentrated risk. And the smart movers reduce that concentration. They open up foreign bank accounts legally and report them properly on the FBAR. They diversify currency exposure. They might buy real estate in the country that they actually want to spend time with, which, by the way, as a tax tip, means that you can actually deduct the cost of visiting your foreign rental property from your U.S. tax return. So yes, pick a place you'd like to visit so you could deduct that trip. Now, I haven't even gone into the value of investing abroad where you could get more for your money in a place like Lisbon or Madrid, where a big apartment in Centro is about $500,000, and you can get a local mortgage for 3 or 4%, which is less than the United States. Or the ROI that I got on my apartment in Medellin, which is literally quadrupled in value in the last 8 years. Now, none of this is secret or aggressive. It's the same diversification principle that people apply to their stock portfolio, except they apply to jurisdictions. And I know this because I do this as well. I have real estate in 3 countries, I have bank accounts in 5 countries, and it's flag theory. It's all about planting flags throughout the world to diversify, whether it's in investments or residencies and passports. And of course, we can help you do that. Now, the third move is the one that ties everything together, and it's the one most people skip because it requires the most planning up front. Move 3 is they pick their tax residency intentionally. Now, where you actually move for tax purposes is one of the most consequential financial decisions you'll make. The smart movers don't just pick a country because they like the weather. They pick based on 3 things at once: lifestyle fit, the tax treatment of their specific income, and the visa residency program access. Portugal, Italy, Spain, Greece, the UAE, and others all have specific programs designed to attract foreign residents on favorable tax terms. Now, each one has its own rules, eligibility, and trade-offs. The country that's optimal for a remote employee earning a W-2 is often different than what's optimal for an entrepreneur with an LLC, which also is different for somebody who's living off investment income or retirement income. Now, when these three moves get sequenced correctly, the difference in someone's tax picture can run into 6 figures a year. And that's not an exaggeration. That's the math that we see across our client base every week. Now, the smart moves we just talked about are the minority. Most Americans who try this end up making one or more of 3 mistakes that quietly cost them most of the benefit. Mistake 1, they don't cut their state tax ties before leaving. Places like California, New York, Illinois, Massachusetts, Virginia are aggressive about claiming you're still a resident even after you moved abroad. So if you still hold a driver's license, voter registration, or use an address in one of those states, you may still be filing as a state resident for years after you left. We've seen clients pay California state tax for 4 years after moving to Portugal because no one told them to cut these ties properly. Mistake 2, they keep on filing the same way as they always did. The day you move abroad, new forms get triggered. The F-bar if you have foreign bank accounts over $10,000, the Form 8938 for foreign financial assets, Form 5471 if you own a foreign corporation, Form 2555 to claim the FIE. I've reviewed hundreds of returns where a domestic CPA filed the exact same return after the client moved abroad. Same Schedule C, same deductions, 0 new forms. The client thinks they're fine, they're not. They just haven't been caught yet. Mistake 3, they confuse moving abroad with no longer owing US taxes. The US taxes at citizens are worldwide income, no matter where they live. Now, renouncing US citizenship is a real option, but it's also expensive, irreversible, and it comes with its own exit tax for high earners. So most people who move abroad keep their citizenship and use the legal tools available to reduce their tax burden. They don't eliminate it, they optimize it. Now, the clients who do this well treat the move as a planning event, not a tax-free escape. So that's what's actually happening behind the headlines. Americans are moving abroad in record numbers, and the smart ones are doing 3 specific things in the right order. Tax planning first, asset diversification second, tax residency third. So if any of this is on your radar, the most expensive mistake you can make is the same one most people make. Doing the move first and figuring out the tax piece second. If you want to go deeper, the next video on the screen breaks down exactly how the Foreign Earned Income Exclusion works. And because that's the single biggest financial lever in this whole equation, watch that one next. And if you want us to look at your specific situation, whether it's tax planning or just opening a foreign bank account for diversification, the link below will get you a call with someone on our team. The earlier in the process you talk to someone who knows the international piece, the more options you have.